Welcome, everybody. Thank you for joining us on this this preview of the currency markets for 2021. We will be talking about, obviously, what's in everybody's mind, the COVID pandemic, the impact of the FX markets, and the prospects for the global economy as we go into 2021, divided between these two factors. One is the pandemic, which continues to rage, and the lockdowns, and the other, the optimism engendered by the good news that we have seen around the vaccine. I will hand over now to Matthew Ryan, our Senior Analyst, to go into more detail as to what we'll be talking about today. And without further ado, we'll get started.
Yes, thank you very much, Enrique. Hello, everyone, and thank you all for joining our webinar today, which, as Enrique said, will be a look back on what's been a very eventful 2020 in the FX market, to say the least, and also a look forward to what we think might happen in the foreign exchange market in 2021. This year, of course, has been an unprecedented year for all of us, and not just for us in terms of our day-to-day lives, but also financial markets in general as well. So we'll be talking about how the markets have reacted to the virus thus far and our expectations for the pandemic next year. We'll also talk about the economic repercussions of these strict lockdown measures on the global economy, and also with a specific focus on G3 and the emerging market economies and currencies in general next year. So as I mentioned, I'll begin the presentation today by talking about COVID-19 and its impact on FX. We'll be talking about the latest vaccine news and how markets have reacted to that, and also give our expectations for which currencies we think might actually outperform on the vaccine news. I'll then talk a little bit about how the global economy has performed so far to the pandemic. I will then hand over to Enrique, who's going to talk a bit more in detail about the main G3 economies and currencies, talking about the latest sort of Brexit news, but our impacts for expectations for a Biden presidency next year. Enrique will then talk about our view on emerging market currencies in 2021. So that should take perhaps sort of 40-45 minutes or so. We'll then have time for questions at the end. Now there is a Q&A function in the Zoom app. So if you have any questions as we go on throughout the presentation, please feel free to type your questions into that Q&A section, and we'll get around to answering those at the end. So as mentioned, I'm going to begin by talking about the COVID pandemic and its impact on the FX market. As mentioned, 2020 has been a very eventful and volatile year, to say the least. Volatility really started picking up in sort of late February, early March time, when the virus started spreading aggressively outside of China. Activity and market panic really sort of peaked in sort of the third week of March. And ever since then, activity and the news headlines in the FX market have been completely dominated by news surrounding the pandemic, both its aggressive spread around the world, imposition of these lockdown measures, and then more recently, of course, the second wave and news of a vaccine. But initially, the market response at the beginning of the pandemic was one of market panic. We saw investors engage in risk-off trading, where we saw them pile into the safe havens, which rallied sharply, and sell risk assets en masse. The stock markets, for instance, equity markets, were generally a good barometer of investor appetite for risk, because they sold off very violently. The S&P 500 index was down by around about a third in the space of a month to its lowest level since late 2016. Commodities suffered heavy losses, led by a collapse in oil prices to its lowest level in 18 years and below $20 a barrel, on concerns of a sharp decrease in demand for the commodity. And the safe haven government bonds actually rose in value as they're deemed a lower risk investment. So with that, given that inverse relationship between bonds price and its yields, these yields on the bonds fell very sharply. Meanwhile, in FX, we saw moves that you would characterize with uncertain periods of trading. So the safe havens rallied sharply, the Swiss franc, Japanese yen, and in particular the US dollar, which is just about the best current performing currency in the world in the sort of 2 weeks or so from mid-March. And that was up against just about every other currency in the world. The flip side of that, we had emerging markets selling off very violently, and also high risk major currencies, the likes of the Australian dollar, for instance, New Zealand dollar, were down very sharply at the beginning of the pandemic. Since then, however, we have seen a sort of a gradual improvement in risk sentiment, and a gradual move higher in these risk currencies. This was first of all supported by the large injection of stimulus we've seen from major central banks and governments. So governments around the world have pumped vast amounts of injection of funds into the market in order to support businesses and individuals, whether that be sort of generous business and personal loans, mortgage holidays, unemployment insurance benefits, or job retention schemes, for instance. We also saw central banks cut interest rates to record lows, either where they were in the financial crisis or lower than where they were in the financial crisis in many instances. These banks also injected vast sums into the market themselves through their asset purchase programs. We saw the likes of the Federal Reserve and the ECB reintroduce their quantitative easing programs, and other banks such as Reserve Bank of Australia, for instance, introduced QE for the first time. Actually, the currency reaction was interesting in this case, and the fact that currencies are actually rallying on the hopes of more stimulus from these central banks, which is a bit of a 180 flip on what we've usually seen, at least prior to this crisis. Infection rates also began to gradually decrease, of course, and economies picked up as these restrictions were unwound, both of which has been good for risk assets. And actually, this last sort of 9 months or so has been characterized by this risk-on mode, where we're seeing the safe havens sell off. So the US dollar is now at its lowest level in 2.5 years against a basket of currencies. And EM currencies have rallied pretty strongly. You see the chart on the right-hand side. This represents the MSCI Emerging Market Currency Index versus the JP Morgan Emerging Market Currency Index. You can see that both of them have risen quite sharply from their lows. The JP Morgan index is around its highest level since March. The MSCI index is its highest level year to date, in part due to the fact that it covers more currencies in Asia that have outperformed a lot of their peers. And even during this second wave of infection that we've seen in the last few weeks, these currencies have rallied, with the market largely overlooking those rising cases in favour of both the vaccine news and this huge amount of support that we've had from both governments and central banks. That leads us quite nicely onto this next slide. As I mentioned, the second wave of infection has sort of dominated the headlines in the past few weeks or so. We've begun to see this big sharp increase in cases in Europe, sort of mid-October, with the US not too far behind in early November, seeing a big sharp rise in cases. The big differences we've seen here is we've seen a bit of a difference in strategy between the two economic areas. In Europe, there's been a return to these strict lockdown measures. Countries such as Germany imposed a 4-week lockdown at the beginning of November, which has since been extended into January. France introduced an even stricter lockdown beginning of November, with other economic areas in the bloc introducing things such as tiered systems or curfews, for instance. And that's helped to drive down the rate of infection, as you can see from the chart on the left. And now they're back down to around about the level they were in mid-October. The US, by contrast, has had a much more sort of sporadic, haphazard, state-by-state approach to these restrictions, whereby some states have imposed very strict restrictions and tough restrictions, such as California, for instance, whereas others have taken a bit more of a hands-off approach. And as you can see, that's the reason why we're beginning to see, or we have seen, a very sharp move higher in new US cases, which are actually at their record highs in both cases and deaths. So partly a reason why we've seen that recent sharp move in euro-dollar, move higher, I should say, in euro-dollar, which is up more than 4% now since the beginning of November. Partly a result of the fact that Europe has got at least some semblance of control over these new virus cases, whereas the US currently hasn't. Investors have kind of sort of lost a little bit of confidence, or any confidence, in the US abilities to both control the number of new cases, and, as we'll talk about slightly later on, actually support people through job support schemes. The last few weeks have, however, yielded some positive news, of course, with the latest news regarding multiple COVID vaccines. Three main ones. Of course, you would have seen a lot in the news in the last few weeks or so, all of which differ slightly from one another. Those are from Pfizer, Moderna, and Oxford University. That from Pfizer and Moderna, both highly effective in the final stage of the trial, around about 95% immune response in those final stages of testing. The issues with these vaccines is they are relatively expensive compared to the Oxford one. Moderna is 33 euros per dose, and the Pfizer is more than 20, or 20, I should say. But also, I have to say, they're also quite difficult to store as well. They require ultra cold storage. The Pfizer vaccine in particular, minus 70 degrees Celsius, which does present a bit of an issue to transporting this vaccine, particularly to some of the harder places to reach in the developing world. We then have the Oxford University vaccine. Now, a benefit of this one is that it's incredibly cheap at €4 per dose, and it requires fridge temperature, albeit it's slightly less effective in testing than the other two vaccines. But news regarding these vaccines has been greeted very positively by the markets, particularly the fact that looks like we're going to have mass vaccinations taking place much sooner than we had anticipated. We were sort of eyeing up the first quarter of next year for when we get the news of the vaccines being rolled out en masse. But the UK has already started vaccinating people using the Pfizer vaccine as of last week. There's a chance that we could see the Oxford vaccine being rolled out in the UK before Christmas. And of course, the US in the last few days has approved the use of the Pfizer vaccine as well, with vaccinations to begin, I believe, later on this week. And Europe, probably again, not too far behind. The EU is looking likely to potentially approve the Pfizer vaccine in early January. So we're getting increased optimism in the markets, hopes that we could have max vaccinations taking place in the first quarter of next year, whereby we could return to some sort of sense of normalcy, perhaps by mid-2021 in some of the developed nations. Now, how have markets reacted to the vaccine news? Well, as I said, the reaction has been broadly a positive one. We're seeing moves higher in risk assets and moves lower in the safe havens. We look at equity markets, for instance, the S&P 500 index is up over 10% since the beginning of November. Firstly, of course, because as a result of the US election, which has been greeted positively by the markets, and then following the news of these multiple vaccines that have yielded a high immune response. Emerging markets have rallied as well. As you can see there, the MSCI EM currency index is up around about 3 or 4% since the beginning of November, slightly less than what we've seen among equity, for instance. We think the reason being because these emerging market countries will likely not benefit immediately from the vaccine compared to some of the major developed nations. Of course, it will take longer for these vaccines to be rolled out in the developing world, and as we'll get to later, they've ordered considerably less doses. So that's, we think, potentially why the emerging markets currencies are slightly underperforming relative to other financial markets. Another notable move that we've seen on the vaccine news is a sharp move lower in the US dollar. Now, of course, the US will probably be one of the countries that benefits the most in the short term, at least, from the rollout of the vaccines. But the market is viewing the mass vaccine rollout as positive for risk sentiment, given that it should lead to improvements in economic activity in the more medium term, which, with the dollar as a safe haven asset, is negative for the US dollar. For 2021, we're continuing to expect largely similar trends. We think that risk assets are pretty well placed to post decent gains in 2021 on the mass rollout of these vaccines. The vaccinations, as I said, have already begun in the UK. We're hopeful that mass vaccine rollout can take place in the first quarter in some of these developed nations. And by sort of the end of the first quarter, maybe April time, we would have seen most, if not all, of those most vulnerable people vaccinated in some of these developed nations. Hopefully we'll see a unwinding of lockdown measures, and an increase in economic activity. We're sort of eyeing the second quarter of next year, where we'll see probably the biggest boom in economic activity. And this is conducive of a rally in risk assets in our view. We think that uptick in economic activity should be good for emerging markets. And we're forecasting sort of broad losses for the US dollar against not all, but for a lot of most perhaps currencies in the world next year. Now, so far we've seen largely a broad move in risk assets as a result of the vaccine news. We actually think that moving forward in 2021, these moves could become slightly more idiosyncratic and dependent on a number of factors, based whether on how each country could perform towards mass vaccinations and towards herd immunity as well. And there's a number of different factors that we've taken into account here. First of all, we think that the currencies from those countries that have ordered the largest quantity of vaccines may potentially outperform, not just the number of quantities of these doses, but also from multiple providers. Of course, it simply wouldn't make sense for one country to order a large quantity of vaccines from one provider, but instead we're seeing them spread the risk a little bit, order from 5 or 6 in the hopes that 1 or 2 of these vaccines prove effective and can be rolled out en masse. Also, those countries that have the infrastructure and processes in place in order to distribute these vaccines quickly and en masse may see their currencies outperform. The developed nations, of course, should be much better placed in that regard. We also think that those economies that have suffered the greatest economic blow during the pandemic should benefit the most from an unwinding of restrictions that the vaccine would bring. So it'd be those countries that have had high rates of infection, high levels of virus death per capita, and also the ones that have had the strictest lockdown measures, the strictest containment measures, we think should benefit the most from the rollout of the vaccine. So this represents the number of vaccine doses that have been ordered per head for a select country in economic areas. You can see from this chart that Canada has by far and away ordered the most number of vaccine doses per person so far, according to The Economist, around about 9.5 vaccine doses per head. There's a little bit of a gap between the second and third in this list. Australia and the UK have ordered just over 5. We then have the US, EU, Japan, anywhere between sort of 2 and 3 doses per head. And then the emerging markets, the developing world, have ordered considerably less. The majority of them less than 1 vaccine dose per head. So not only do we think it's going to be difficult for the vaccine to be distributed to these emerging markets, we'll have difficulties with storage in some instances, but also, as this chart shows, they've ordered considerably less vaccine doses for the obvious reasons that they simply have less wealth than the developed nations. So again, we think this is partly the reason why we're not seeing emerging market currencies rally as much as perhaps they would have done on the vaccine news. And actually, if we look at some of the higher risk G10 currencies, they seem to be outperforming a lot of these emerging market currencies. So the likes of the Australian dollar, for instance, one of the highest risk currencies in the G10, has performed very well in the last few weeks, and better than also these emerging market currencies on the vaccine news. Again, as I mentioned, we think that the currencies that might benefit the most from the vaccine could come from those countries that have had the strictest lockdowns, and therefore will benefit the most from an unwinding of these restrictions. You can see from these 2 charts, these represent the COVID-19 Government Response Stringency Index from Oxford University. The countries on the left, these represent where the lockdowns have been the strictest over the course of the pandemic. So look at the likes of the UK, Europe, the US, Canada, Mexico, for instance. Those countries on the right, those represent where the lockdowns or the containment measures have been slightly easier, have been slightly looser, more relaxed during the course of the crisis. So we think that those countries that have had the strictest lockdown measures, as I mentioned, would benefit the most from the vaccine. Those on the right, the likes of Australia, New Zealand, Japan, for instance, we think may not benefit as much once these restrictions are unwound. They've already returned to some sense of normalcy in many aspects of their life. Once these restrictions are unwound, we think the boom will be slightly less for these countries than the ones that I mentioned on the left. So a couple of currencies we think that could be set to perform the best on the vaccine news would be sterling and the Canadian dollar. So both of those countries have ordered vast amounts of the vaccine, have the infrastructure in place to roll it out en masse. And also, as we can see here, have had the strictest lockdown measures in place over the course of the crisis. Now, before I hand over to Enrique, who's going to talk more about the G3 currencies in detail, I'm going to give an update on how the global economy has performed so far in 2020 and what to expect next year. Now, 2020, as I said, has been a roller coaster year for all of us, and it's also been a roller coaster year for the global economy. The first couple of quarters of the year, we saw these strict lockdowns put in place. Economies contracted by record amounts, not so much in the first quarter because these containment measures were not put in place until late in the quarter. But in the second quarter of the year, we saw downturns that were the largest on record. You see from the chart on the top right, where we saw a lot of the major economies contract in excess of 10% quarter on quarter. Activity rebounded strongly in Q3 as a lot of these virus restrictions were lifted, and domestic demand was very well supported by governments, particularly job retention schemes in the likes of Europe. But we think we're heading for another downturn in the fourth quarter of the year, particularly in Europe and in the UK. The national lockdowns, of course, as I mentioned, have been reimposed across much of Europe, France and Germany. We're also seeing other measures imposed as well, curfews, tiered systems, for instance, the closure of hospitality venues. So we were expecting both the UK and Euro area economies to contract in Q4. We actually think that the US economy could outperform in the final quarter of the year. As we've mentioned, the restrictions have been slightly less strict in the US. It's been more sporadic, more haphazard. We think the US economy is likely to outperform, which may provide a little bit of an upside surprise for the US dollar. And if we look at the latest PMI indicators, they've shown signs of diverging as well. So the chart on the bottom right, you can see the PMI index for the US is now around about a level of 60, which has come to the expansionary territory, whereas in the UK and the Euro area, it's fallen below the level of 50 to denote contraction. So we're seeing a bit of a divergence in economic performance. As I said, it could provide a little bit of a short-term boost for the dollar. So our general view on 2021, we're pretty optimistic about a rebound in the first half of next year. And for many of the reasons I've mentioned, likely have mass vaccinations in the developed world in the first quarter. We're hopeful of an unwinding of restrictions by the spring. Also, fiscal monetary policy are likely to remain very highly accommodative. Governments have already pledged to support jobs throughout next year in many places, such as France and Germany. Central banks as well have also pledged to keep interest rates low for the foreseeable future, which should help support demand. And there is lots of pent-up demand among consumers as well. So we think that once these restrictions are unwound, we could see quite a sharp move higher in economic activity, which we think is conducive for a conducive environment for a rally in risk assets next year. I'll now hand over to Enrique, who's going to cover the G3 currencies.
Okay, thank you, Matthew, for that. Very interesting. Before I dive into the individual countries, I'd just like to reinforce Matthew's message that we think that the conditions are in place for a very strong rebound that perhaps will surprise policymakers, both monetary and fiscal, for its strength. We have very extremely supportive monetary conditions everywhere. Interest rates are zero, almost across the curve in every major economic area. We have fiscal authorities that are in some places more than others, especially in the Eurozone, less in the United States, ready to spend enormous amounts of money. And we have vaccination programs that have been launched earlier than most expected and are going to get rolling and probably should be completed or nearly completed in most jurisdictions by early the second quarter of 2021. Those are conditions for potentially a very strong rebound in demand. So let's first look at the United States, where I think that it may be a bit of the laggard in 2021 in relative terms, relative to the Eurozone. But in absolute terms, we also expect to see a significant rebound there. The reasons why we are slightly less optimistic in the US economy than the Eurozone have to do with how the US has reacted to the crisis. There's been support, there's been fiscal stimulus, but the US has not made the same effort that Eurozone countries have made to keep in place businesses, especially small businesses, and the productive structure of the economy, and instead chose to give out very generous unemployment benefits, which have run out a few months ago. Very generous individual checks to taxpayers that also ran in July. And since then, after that very generous initial response, Congress has stalled, has devolved into partisan politics and partisan bickering. And it seems like whatever stimulus gets agreed on will be a lot more modest. And in the meantime, we will have seen significant destruction of the economic fabric in terms of small businesses going under and people losing their jobs, not on a temporary basis, but on a permanent basis. That's the negative aspects for the US going into 2021. The positive aspects, like everywhere else, is an extremely supportive monetary stance with the Federal Reserve be standing ready to do whatever it takes, not just in terms of keeping rates at zero for very long, but additional programs if necessary. And also we have this, that the labor market hasn't done as bad as first feared. I mean, this is a very complicated graph, the Beveridge curve, that relates the number of job openings to the unemployment rate, and essentially gives you a sense of the health of the labor market. How well are open jobs being matched to unemployed people? We want to be in the upper left part of that graph. And as you can see, the initial unemployment spike was extremely sharp and extremely fast, but the rebound has been equally fast. And it looks like we've returned back to a reasonable level in unemployment and openings. That means that the damage from the pandemic may not be, to the economics, to the labor market structure may not be as bad as feared. So this is another thing that suggests a V-shaped rebound. We don't have, unfortunately, a similar graph for the Eurozone, but similar analysis at some of the major country levels also support that the Eurozone labor market has been relatively resilient through this pandemic. So could we move to the next slide? The Fed is essentially the great hope of the United States economy. As Congress sort of dithers and tries to and fails to agree on an additional stimulus or programs to restore the economic fabric, the Fed slashed rates to zero. They restarted the quantitative easing program, and more importantly, it seems to have made a very credible commitment to keeping rates low, no matter what happens to inflation. It has promised markets that even if inflation starts taking off, and as we'll see, there's a good chance that in 2021, we'll see at least a modest rebound in inflation. Even if that happens, the Federal Reserve has made it very clear that they will keep rates at zero. This is the dot plot. This is probably the most informative single graph that the Federal Reserve puts out at its meetings, where every member has to give a sense of where they expect to see rates at the end of each year. And as you can see, every single member except for one agrees that they will be at zero into 2022. And the vast majority say that the rates will still be at zero 3 years from now, which is a bit unprecedented. It seems like there's, however, no appetite to go below zero, to have negative rates like the European Central Bank did. It seems like they don't think it's necessary, and they think that that the negatives outweigh the positives of going into negative rates. But clearly, this is an extremely, extremely stimulative stance of monetary policy, and one that pretty much forces investors to take risks and makes it very easy for business managers to justify investing and hiring because of the cost of capital being so low. So we could go to the next one. We have a Biden administration that is going to take over soon, in a matter of a month. It's still not clear what's going to happen to the Senate. The House remained in Democratic hands. The Senate, there's still 2 runoff elections in Georgia that might mean that the Republican majority gets thinned down further. But right now, the odds are of 70% odds that the Republicans will keep control of the Senate. That's our scenario, a divided government. That means that the fiscal package, there will be a fiscal package, but perhaps the text is a little too optimistic. It will be limited. It's an unambiguously positive element is that we will not see the same level of protectionism and willingness to tear up trade relationships and supply chains that we saw under Trump. But other than that, other than the absence of or the much reduced likelihood of significant trade conflicts, we don't think that a divided government will change much. And again, we'll see a very modest fiscal package, which is better than nothing, but not much more than that. So, next slide. By contrast, we are somewhat more positive in the euro area economy. Again, all the baseline for all the major economies in the world, we think is quite positive in 2021. So we think that the European economies are going to outperform the US economies in relative terms. We think that all of the economies are going to subscribe on the upside. We're going to get back to to pre-pandemic economic levels, we think sooner than most strategies and central banks expect, given the very favorable mix of factors out there. But some economies will outperform others, and we are particularly positive on the European area economy. We will see a contraction in Q4 because of the second round of pandemic restrictions and lockdowns that were implemented. This, however, will be much less marked, much less of a downward contraction than we saw in the second quarter, but there will be some contraction. However, looking into 2021, the European Central Bank policy remains highly accommodative. Not in the last meeting, not only did the European Central Bank increase already extremely generous pandemic programs and intervention, but it also revealed that it's ready to do more. So the barrier for any removal of accommodation and stimulus is going to be very, very high. Whereas the ECB, we think, stands ready if numbers disappoint in any way, the response is going to be quite asymmetric. The European Central Bank will respond much, much harder and faster to any perceived downdraft in the economy than it will to any outperformance. So the European Union, the recovery package will be made available in January. So over the first quarter and second quarter of next year, you will have massive deficit spending by European governments, supported by both the recovery package and the ECB's willingness to buy the debt of those sovereign countries through the pandemic, through the PEPP program, which has been increasing in size and now is very, very large. You will have the progressive removal of all the lockdowns that are now hovering, especially the service sector, as the vaccines get rolled out. That's at least our view. And you will have the effect of the fact that most small and medium-sized companies have been able to survive the pandemic thanks to various job retention schemes. All of this combined with the extremely stimulative setting of policy from the ECB is a recipe for a significant increase in demand from pent-up demand, consumers that haven't been able to travel or to enjoy themselves for many months, companies that have postponed investment. All of this will come together, we think, in the second quarter of 2021, and it will mean a very strong rebound. The ECB is projecting growth of 3.9% in 2021, and to regain the ground lost in the pandemic sometime in 2022, we think actually that those numbers are a bit conservative, and we expect them to be higher. So next slide. The European Central Bank is a big differentiating factor between this crisis and the last one. The European Central Bank has been extremely aggressive, as much, if not more in some instances, than the Federal Reserve in its response to this crisis. No rate cuts have been implemented of any importance, but that's because rates were already as stimulative as they could be at negative. The QE program, the regular program by which it supported the sovereigns in the European Union and enabled them to issue debt, has been expanded. It has launched an additional program for purchasing the debt of sovereign that has been recently expanded yet again to a massive 1.85 trillion. But even more important than that, what Lagarde said at the last meeting is that 1.85 trillion is sort of almost a figure they pick out of a hat. It will be whatever is needed. If more debt is needed, or more deficit spending on the part of government is needed, the European Central Bank will support it. The one negative factor that has appeared perhaps that would dampen this optimism a little bit is the very fast appreciation of the euro, especially against the US dollar. We think that as long as we don't go much further than where we are now, around 120, 121, there's no need to change our predictions about the strong economic rebound in the Eurozone next year. If, however, we were to see a continued rally towards 125, we think that the European Central Bank would do more than express its concern, and it might take additional easing measures to prevent that from happening. Next slide, please. The other large economic area that clients are concerned with is obviously the UK. Here, the predictions, this are even harder than usual, even harder than the case of the US and the Eurozone, because to the uncertainties over the pace of the rebound, the pace of the lifting of the lockdowns, the rollout of the vaccine, etc., we have to add Brexit. Which remains highly unclear what will be the short-term impact of Brexit on the UK economy. We have maintained throughout a certain optimism that a modest deal would be reached in time. It looks like events have validated that optimism. Even as we speak, it looks like there's some headlines coming from the German ambassador that they expect to reach some sort of agreement this week. This is supported by most betting markets. People with money at stake are now, I think, at 75 to 80% chance of a deal versus 40% before the weekend negotiation sprint. However, we doubt that this will have a dramatic impact on sterling. The reason for this is that the market has mostly priced in that there would be some sort of last-minute agreement. There's too much at stake for both sides not to compromise. So while the removal of the last vestiges of uncertainty about a no deal may have a positive impact on sterling, we think at current levels of like 133, 134, maybe at most $135 to the pound, the optimism over the absence of a hard Brexit is already priced in. So we do not expect a sharp move high. A no deal would definitely be very bad news for sterling, but it looks like we're very close to ruling that possibility out, which is excellent news. Next. The UK economy suffered. I mean, we do expect a sharp rebound in the UK economy, but that's partly because it suffered one of the worst contractions among developed nations, 19.8%. I believe that only tourism-dependent countries like Spain and Portugal had a worse contraction than the UK. The reason for this sharp contraction were that very hard lockdown measures that were necessary in the UK to stop the virus. Also, the fact that the UK economy, as a service-based economy, rather than a manufacturing one, is more exposed to the virus than, say, like the German economy, where manufacturing, which has been less affected by the crisis, has a bigger weight. So a service-based economy, the necessity for very sharp measures to contain the virus meant that even after the third quarter rebound, the economy is 8% lower than in October. Again, in the UK, much like the Eurozone, we are very optimistic about rebound in 2021. This is partly because we think that the impact of Brexit will be felt in the long term. It will be a long-term negative for the UK economy, but in the short term, we expect very little to change thanks to the agreement. The UK government, like European governments, has made a tremendous effort to keep the productive fabric of the economy, especially at the small and medium-sized business level, in place. The expensive but useful furlough scheme was extended until March. Mass vaccination are on the way, with maybe 1 or 2 weeks lead over other advanced countries. And the final reason for being optimistic in UK growth is that the second wave seems to be receding faster in the UK than in the peer countries, which will enable Boris Johnson government to relax the lockdown measures ahead of Europe. So we could see the rebound in the UK start as early as the first quarter of 2021. Next slide. The Bank of England is largely, it has done pretty much all it can, and its communications recently seem to acknowledge this. Rates are essentially at 0%, 0.1%, technically above zero, but effectively zero. There's been a near doubling of the quantitative easing program. Again, this number of £895 billion is sort of, it's not tremendously important, as in the case of the BEPP program in the European Central Bank. It's meant to transmit to markets the clear sense that the Bank of England will do whatever it takes to support the UK government's ability to issue debt and finance deficit spending. That's what the number means. It has also addressed loan programs directly to SMEs with some success. And negative rates in England, as in everywhere else in the world, especially in the US, seem to be increasingly receding into the set of tools that central bankers are unwilling to use. I think the experience of the Eurozone on negative rates has been mixed. Whatever additional stimulus you get from negative rates seems to be outweighed by the damage done to bank profitability. Negative rates are significant negative for banks, bank profits, because banks have found it much harder, I think, that the European Central Bank expected to pass on those negative rates to savers. And so the rest of the main central bankers are going to be very loath to follow the European Central Bank into cutting rates below zero. Right now, markets are pricing less than a 1/3 chance that rates will be cut below zero. We think actually that is too high, and that especially for our projections for a faster than expected rebound in most economic areas materialize, there will be very little pressure on the MPC to implement negative rates. Next slide. And emerging market currencies. This is probably our strongest conviction forecast that the emerging market currencies should outperform most as a group G10 currencies, whether the euro, the dollar, or sterling. The reason for this is that they sold off very, very sharply at the beginning of the pandemic, but only benefited partially from the general rebound in risk appetite, and they still have significant ground to make up. Since emerging market currencies tend to be leveraged to like the global economic cycle and the prices of commodities, the scenario that we have in mind where the economy, especially in advanced countries, rebounds faster than expected, inflationary pressures, at least modest ones, come back faster than expected, and commodity prices rise faster than most expect, that is a cocktail that is very powerful and positive for emerging market currencies. If you add to that the fact that right now these emerging market currencies are trading at historically cheap levels, even after the recent rebound, and that investors in G10 countries are being forced to seek out investments that produce reasonable financial returns, now that risk-free investments like treasury bonds or German bonds essentially yield close to nothing. All of that together is one of the most positive environments that we've seen for emerging markets currency assets in general, and emerging market currencies in particular around the world. So if we go to the next slide. Here's an illustration of how which currencies have performed better than others. This is the year-to-date performance versus the US dollar of these currencies. This a couple of conclusions are immediate from this chart. Asia, no surprise, Asian currencies have outperformed their peers everywhere else in the world. This definitely probably has to do with the fact that Asian countries got their pandemic under control relatively quickly and were able to restart the economies. There's also the increasing sense that the Chinese yuan is behaving more and more like a fully developed currency, like another G10 currency, and is no longer can be considered an emerging market currency. People are using it increasingly as a store of value. Reserves worldwide are slowly being added denominated in yuan, other countries' currency reserves. And this stabilizing influence is also helping its peer currencies like the Taiwanese dollar and the Korean won. Again, this is just to reemphasize that the cocktail that we see for 2021 that is positive for growth is also very positive for emerging market currencies. As a whole, though, it is a good idea to pay very close attention to the fundamentals because we think that in addition to a general rally of emerging market currencies as a class next year, we will have some pretty sharp differences in the performance and the behavior of some of them according to the strength of the fundamentals. So what are the factors that will drive some emerging market currencies to perform better than others? Obviously, the first one has been and will continue to be the ability of the authorities to control the pandemic and to restart the economy safely. This obviously benefited last year Asian currencies, and that's clearly seen in the rankings and the outperformance of the currencies around the Pacific Rim. The timing of the vaccine rollout. Those are the two factors that will dominate, at least in the first half of the year. However, in the second half of the year, once the pandemic, we start putting the pandemic behind us, we will go back to the traditional fundamentals. The critical aspect will be the domestic fiscal and monetary response, the capacity of the individuals' governments to carry out that fiscal and monetary response. And that capacity will be a function of the existing pool of external debt that has to be serviced, the FX reserves that the country has managed to accumulate, and the current account balance, which tells us the extent to which the country needs to borrow from the rest of the world or lends money to the rest of the world. And here again, we can see that Brazil and China are probably two of the countries better situated in this scheme. The Chinese yuan largely reflects already this positive factors in China because it has performed very well. The Brazilian real, however, still has a lot of ground to make up from the losses earlier in the pandemic. So we are quite positive on the prospects of the Brazilian real into 2021. Next slide. And that's it so far. I think we have time for a couple of questions. Yes. The first one is, we haven't mentioned Africa. That's a good, an interesting topic. We think that within the EM complex, in Africa, most of the currencies with countries with decent fundamentals will be significant beneficiaries of the rebound in economic activity, inflation, and commodity prices that we foresee for 2021. I think that in particular, an increase of commodity prices from the currently somewhat depressed levels is probably the biggest factor that is supportive of African currencies in general. Now that said, in Africa, the idiosyncrasies of its country are even more important than elsewhere. The countries, there's this sharp variance between the quality of policymaking and the strength of the economic fundamentals across different European countries, African countries. In general, the currencies of East Africa, Kenya, Tanzania, etc., tend to be among the better managed. And so we expect stability or better in those currencies, generally speaking. But again, it's a matter of digging into each individual currency. And I will let Matthew take the next question.
Yeah, so the second one was on Brexit, and particularly its impact on the Eurozone. Actually, it's quite a difficult one to tell at the moment. Of course, we're still deep in negotiations, UK and EU, as to this full trade agreement before the end of the transition period. Actually, there's still quite a lot of negotiations to go. Even if a deal is done by the end of the year, there'll be continual negotiations in the next few years, which will really flesh out this trade agreement. So the actual specifics of the deal, I think it's going to be very difficult at the moment to tell what kind of more a long-term impact Brexit is going to have on both the UK and on Europe. I think it was my sort of personal view. I think if we do get a deal done before the end of this year, which is, as we say, is our base case, actually, I don't think we'll see a huge amount of impact on the Eurozone in the sort of short term, sort of over our forecast horizon. Certainly don't think we'll see much of an impact on the euro. We might see a little bit of a move higher in the euro in the short term. But I think a no deal would be a negative, without a doubt, for Europe and the UK, of course. Slightly, obviously, less of an impact for Eurozone. But I certainly think we'll see a bit of a downside in the euro economy and the euro if we were to get a no deal. We have another question, Enrique. Maybe
yes.
The
outlook for the Singaporean dollar in 2021. It did get cheaper against the euro. Most currencies got cheaper against the euro in 2020 when we had this late rally. We don't think it will go back to the same level of 2020, but we do think that over the short term, there is a decent chance, in spite of a general positive outlook on the European Union economy, on the short term, we expect to see the euro stabilize or even pull back a little bit. So we think that the euro will cheapen out a bit against most Asian currencies in the first quarter of next year.
Yeah, I think the point about the Singapore dollar is one of those currencies that is very closely controlled by the central bank. So the Monetary Authority of Singapore engineers the Singapore dollar very closely against the US dollar. So I think at the moment their band is a very mild appreciation of the currency against the dollar. So actually our sort of euro dollar view, I think, will actually be quite similar to our view for euro and Singapore dollar. We have another question on the Swiss franc and future development of Swiss franc against the dollar and the euro. And what are your thoughts?
I mean, our view is that this is like, I feel like the Singaporean dollar. This is a very tightly managed currency, the Swiss franc. We think that the Swiss franc, the Swiss central bank is unlikely to allow any significant appreciation against the euro. So the Swiss franc is going to trade at current levels or somewhat below versus the euro. And so over the long term, we expect to see some modest appreciation of the Swiss franc versus the dollar, combined with some even more modest depreciation against the euro, as the economic developments that we expect for 2021 happen. We think that the Swiss franc will lose some of its attraction as a risk haven, and we wouldn't be surprised to see it closer to 110, 112 by the end of the year versus the euro.
We have another question there, which is if tariffs are put on the UK imports from the EU, that would be in the event of a no deal, I would assume. Would sterling be devalued to make up for this? I certainly think, yeah, absolutely. I think authorities in the UK would certainly be happy and comfortable with a slightly weaker pound. The impact of tariffs, of course, it would certainly push up prices, also weigh on UK growth, and the GDP forecasts for a no-deal Brexit are pretty severe, particularly over the longer term. It's expected to weigh on the UK economy quite a bit over the next few years. The effect, if we were to get a weaker sterling, that should at least offset some of that downside. So I think absolutely, I think the Bank of England, for instance, I think would be very comfortable with a slightly weaker sterling in that event, which is why we think investors would sell sterling quite sharply in the event of a no deal. I have another question on the Euro CNY. So what's our forecast for Euro CNY and a view on CNY, Enrique, for the next year?
I think that, yeah, I'm looking it up right now because I don't have the exact number in my head. I think it's probably best if we attach to this presentation that's going to be distributed our detailed forecast for every currency pair that we forecast. In the meantime, let me look this up. Our forecast for year-end 2021 is we forecast versus the dollar, and we have it at 6.75. But we will share these forecasts in an addendum to the presentation.
Yeah, I think that's a good idea.
Yeah. Okay.
I think we're just about reaching the end of our time now. I think
yes.
Very good.
Sorry, so I think that, yeah, the best way to deal with the individual request for forecast is to attach our overall matrix of forecast to the presentation and distribute it.
Yeah, that sounds good. Yeah, thank you everyone for joining and for all your questions. We're hoping to do more of these in the new year as well, aren't we? So yeah, look out for further invites for some more of these webinars in the new year.
Absolutely. Thanks everybody for coming.
Okay, thank you everyone.
Bye-bye.